Hey everyone, welcome back to BizChain, where we simplify business, finance, and crypto so you can grow your wealth with confidence. Today we re-diving into one of the most important skills in crypto trading, how to read crypto charts. If you've ever looked at a Bitcoin or Ethereum chart and thought, what do all these candles, lines, and squiggles mean? Don't worry. By the end of this video, you'll understand candlestick charts, support and resistance, moving averages, RSI, MACD, and more. Stick around until the end, because I'll also share a simple beginner strategy you can use right away and the common mistakes to avoid. Section 1. Candlestick Basics. Let's start with the foundation of every chart, candlesticks. Each candlestick represents a period of price action, whether that's 1 minute, 1 hour, 1 day, or any time frame you choose. A candlestick shows 4 key things: open price, close price, highest price during that time, lowest price during that time. If the candle is green, it means the price closed higher than it opened. The market went up. If it's red, the price closed lower. The market went down. Candles form patterns that traders look at for signals. For example, a doji candle, tiny body, long wicks, signals indecision. A hammer after a downtrend can suggest a reversal. Consecutive strong green candles often show bullish momentum. Once you master candlesticks, you can see not just what happened, but also how traders were feeling. Fear, greed, indecision, all packed into those little candles. Section 2. Timeframes charts are all about timeframes. 1-minute or 5-minute charts are used by day traders looking for quick moves. 4-hour and daily charts are popular for swing traders. Weekly charts give long-term investors the big picture. Here's the trick: the bigger the time frame, the stronger the signal. A support level on a daily chart is way more reliable than one on a 1-minute chart. So if you're a beginner, focus on the 4-hour and daily time frames. They filter out a lot of noise and give you clearer signals. Section 3. Trend structure. Next up, trends. Markets move in 3 ways: uptrend, downtrend, or sideways. An uptrend is higher highs and higher lows. A downtrend is lower highs and lower lows. A sideways trend means price is ranging between support and resistance. Your first job as a trader is to identify the trend. Don't fight it. If the market is trending up, look for buying opportunities. If it's trending down, look for shorts or stay out. Remember, the trend is your friend until it ends. Section 4. Support and resistance. Now let's talk about support and resistance, the invisible floors and ceilings of the market. Support is a price level where buyers step in and stop the price from falling further. Resistance is where sellers step in and prevent the price from going higher. If Bitcoin keeps bouncing at $30,000, that's support. If it keeps failing to break $35,000, that's resistance. Once price breaks through these levels, they often flip roles. Old resistance becomes new support, and vice versa. Smart traders draw these zones on their charts to know where to enter or exit trades. Section 5. Volume. Volume shows you how much crypto is being traded at each price level. High volume on a breakout equals strong confirmation. Low volume breakout equals could be a fake out. Always check volume to see if the move has real strength. Section 6. Moving averages. Next tool, moving averages. A moving average smooths out price action so you can see the trend clearly. 2 common types: SMA, simple moving average. EMA, exponential moving average, gives more weight to recent price. Traders often use the 50-day and 200-day moving averages. If the 50-day crosses above the 200-day, called a golden cross, bullish. If it crosses below a death cross, bearish. Think of moving averages as the market's heartbeat. They help confirm whether we re in an uptrend or downtrend. Section 7. RSI. RSI, or the Relative Strength Index, measures momentum. It's a line that moves between 0 and 100. Above 70, the market is overbought, may pull back. Below 30, the market is oversold, may bounce. But here's the secret: RSI divergence. If price makes a new high, but RSI makes a lower high, that's a bearish divergence. Momentum is weakening. That's often an early warning sign. Section 8. MACD. MACD stands for Moving Average Convergence Divergence. It has 2 lines, the MACD line and the signal line, plus a histogram. When MACD crosses above the signal line, bullish. When it crosses below, bearish. Histogram bars show momentum strength. MACD is like a second opinion to confirm what RSI or moving averages are showing. Section 9. Bollinger Bands, 9 to 10 o'clock. Bollinger Bands are another popular tool. They consist of a moving average in the middle, with two bands above and below that expand and contract with volatility. When price touches the upper band, it's often considered overbought. When it touches the lower band, it's often oversold. But the real trick is the squeeze. When the bands contract tightly, it signals low volatility, and usually a big move is coming soon. Section 10. Entries and exits. Now let's put it all together. How do you actually enter and exit trades using these tools? A good entry happens when multiple signals line up. For example, price bouncing off support RSI showing oversold volume confirming buyers are stepping, and that's a high probability entry. For exits, you want to secure profits before the market reverses. Use resistance levels, overbought RSI, or bearish divergence as clues to lock in gains. Never enter based on a single indicator. The best traders look for confluence, multiple reasons pointing in the same direction. Section 11. A simple beginner strategy. Here's a simple beginner-friendly approach you can start with. 1. Pick the 4-hour or daily chart, clearer signals. 2. Draw support and resistance zones. 3. Check the trend, only trade in that direction. 4. Confirm with RSI and MACD. If price bounces off support, RSI shows oversold, and MACD crosses up potential buy. If price rejects resistance, RSI overbought, MACD crosses down potential sell. 5. Set stop loss below support or above resistance. 6. Set a realistic target, like 2:1 reward to risk. This way, you're not gambling. You're following a structured system. Section 12. Mistakes to avoid. Before we wrap up, let's cover the biggest mistakes beginners make. Chasing pumps, buying after the price already shot up, ignoring time frames, relying only on 5-minute charts, overloading indicators. Don't clutter your chart with 10 tools. Pick 2 to 3 solid ones. No stop loss. This is how beginners blow accounts. Always protect your downside. All right, now you know how to read crypto charts, candlesticks, support and resistance, moving averages, RSI, MACD, and Bollinger Bands. If you found this helpful, hit that like button, subscribe to BizChain, and turn on notifications so you don't miss the next video. Question for you. Which indicator should I break down in more detail next? RSI, MACD, or Bollinger Bands? Drop your answer in the comments. Thanks for watching, and I'll see you in the next one.